It's laughable, actually, Cory, that I would care about a client receiving $2,000 a month from Social Security versus pulling $2,000 a month
Agreed.
from their account. If that's going to change my lifestyle or my paycheck that much, I've got bigger problems.
Yeah, you're not much of a professional. No offense.
Right.
Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Hello, Jake. Thank you for having me back on the show.
It's good to have you back, Cory. Spring is in the air. Do you have any fun facts or tidbits you want to share with our audience before we dive into today's episode?
We just got a new fence at home. That's a fun fact.
Oh, I didn't know you were doing that, Cory.
Yep, we got a new fence. So we have desperately needed that since we moved in 4 years ago. And that's one of the items that I've continued to punt. But I have told my wife, Cassie, that some of these things I've been punting for a few years, we're taking care of them before the baby comes. So we have a nice new fence.
So tell me about the fence. So is it because you got a weird kind of setup where your garage goes back. Is it a iron fence? Is it a wood fence? What do you got going on?
It's a cedar privacy fence. So basically we replaced two sides. The other side is the house, and then that iron fence that you're talking about. So now there's a gate on the west side of the house so we can enter the backyard from either side. Nice new fence. And I don't have to worry about whether or not the dog is going to knock it down when he's jumping up trying to chase it.
Nice. Now, are you going to paint it or stain it?
Stain it.
Stain it. Okay, cool.
Yep.
Good for
you.
How
about you? What's new with you?
Not much. Golf season's in the air. I've got my first Falcon Wealth Advisors tournament coming up, so I'm excited for that. By the time this episode gets aired, I will have already played. So hopefully I had a fun round. And that's it, really. Just Rachel and I are enjoying the new home. You know, we bought a piano, which is pretty cool. Neither of us know how to play, but we're learning. Piano's an awesome, beautiful instrument, and I'm excited. She's better than me.
That's what I was going to ask you. Who's progressed more quickly?
Well, to be fair, she said she had piano lessons when she was a kiddo, so she's got that on me. But I also played the violin, so I think I can hang with her. I just got to keep practicing. It's fun. We've both been enjoying it. So
if I know you the way that I think I do, Jake, if you just are as consistent with that as you are with everything else, that you will be a great piano player.
Yeah. I'm working on it. So thank you. So that's been a lot of fun. And to all of our listeners and viewers out there, I want to thank you for continuing to download and listen to and absorb our content. Please like and share it. The whole point of Cory and I recording Upticks is to enhance financial literacy at scale. So again, if nobody's listening or watching this, we're not helping anybody. So again, Please share our content, and thank you for tuning in. And a quick thank you to Luke, our communications manager, for editing and getting all of our shows published. If you have a suggestion, it doesn't have to necessarily be an article. It could be any financial topic that you would like Cory or myself to discuss or argue. We'll argue it.
Debate.
So if you want to do that, simply email Luke at falconwealthadvisors.com, and Luke will make sure that your topic gets discussed live right here on Upticks. All right, Cory, I did have a suggested topic, though, that I wanted to talk about today before we dive into today's articles. So why don't you tee that up for me?
Yeah, so let's talk, Jake, about getting 5% on your cash right now and why you think that's important.
Yeah, so if you've heard of the old adage, Cory, don't fight the Fed. Well, the Fed has come out and they've hinted at, or maybe been even more explicit, that they're probably not going to lower interest rates anytime soon. Okay? And my perspective, Cory, and I want to hear yours on this, is that I'm actually okay with that. I don't think the Fed needs to lower rates. And really for the sole fact that the economy is very healthy. We are nowhere near a recession. Unemployment numbers are very strong. Yes, people are griping about higher mortgage rates, but you know what? Mortgage rates right now aren't that high when you're looking at a historical perspective, right? Many of our clients, Cory, remember when their mortgage was 14% or 12%, right? They're not that high. So I'm completely okay with it. And my point on the cash is that So if we know rates are not going to drop overnight, what are you doing with your cash? And why are you allowing your bank to pay you 0.1% or 1% or even 2% when your friends at Falcon Wealth Advisors, we've got an excellent offer through Goldman Sachs, where currently, as of the recording of this episode, Goldman Sachs is paying our clients 5.25% interest on their cash. Let's do that. Cory, though, before we go on to today's headlines, what are your thoughts about the Fed? Are you anxious or wanting them to lower rates here soon?
I'm not anxious about the Fed, to answer that question, Jake. The messaging, I mean, it literally is much different than it was like 3 weeks ago. So I take it all with a grain of salt. Recognize that nobody at the Fed can really see into the future any better than me or you, Jake. But everything that you've stated here today absolutely holds true. And I do think going back to late 2022, the one message the market has continued to miss the mark on is around interest rates. In 2023, Jake, everybody was predicting how much rates would come down, and they didn't. Rates actually went up. In 2024, the beginning of the year, people were expecting rate cuts. Maybe the market was pricing in maybe for the Fed to start cutting rates 3 months ago in January. Didn't happen either. So exactly what you've highlighted here today is exactly what people can do to take advantage of the environment that we're in. And all it requires is just a little bit of inertia.
Right. And let's remember, we don't want the Fed to cut rates too soon, because if they cut rates too soon and then we get into a recession, well, then they're going to have to do quantitative easing or some of these other things, which then will probably create inflation again. So it is a juggling act. It's a teeter-totter. It's a balance, whatever you want to call it. It's not an easy job, the Fed, what they have. However, again, if they're going to keep rates higher for longer, then let's make sure that your cash is earning an appropriate rate on it. That's all I'm saying here. And again,
perfect summary.
It's a little bit of action on your part for the client. All you got to do is reach out to us. There's some enrollment that you've got to take care of through Goldman Sachs on your end, because it's not custodied with us. But again, it's well worth your, I don't know, Cory, how long did it take you to set up your account? 15 minutes? Like, it's well worth your time. I think it was more like 10. Yeah, it's well worth your time. So definitely, if you're sitting on some cash, let us know, and we're happy to help you get that set up. All right, Cory, let us, I missed this last week, maybe the week before. Play ball.
Ball.
All right, Cory, the hidden costs of home ownership are skyrocketing.
Yes. So homeownership, Jake, homeownership affordability, which is measured in a lot of different ways, fell to its lowest level since the early 1980s last year, because mortgage rates have gone up, like you stated, but home prices. And to be clear, like you mentioned, Jake, people remember when interest rates were a lot higher. Relatively speaking, they're not that high today. What really is, for a lot of homes, what is high is the price. So if you're financing $500,000 at 6.5%, that's a whole lot different than 50 grand. But the point here is, from a homeowner affordability standpoint, rates have reached 25-year highs. We've seen affordability come down, and it's really around property taxes, home maintenance costs, utilities. Those are non-mortgage homeownership expenses that can make up more than half of homeowners' overall costs, according to Freddie Mac. So the takeaway from all of this is, I think anybody who is a homeowner has experienced this probably to some extent, whether it's their gas bill, electric bill, homeowner's insurance, whatever it might be. But there's a lot of expenses that are involved with owning a home, with shelter beyond just a mortgage cost, which is important. And the real big takeaway from this, Jake, is to shop your insurance, plan accordingly, recognize that this is what's going on. Rather than just sitting on our hands and being unhappy about it, let's take some action to see what we can do to improve the situation, because it is a reality for people all around the country. And having a conversation with an independent broker to make sure you have the right coverage to shop it for you is a wise move in the environment that we're in now.
Yeah, good, Cory. Have you heard of the Property Brothers? You know who they are?
Mm-hmm.
Yeah, so they were on the news this morning. They're the twin brothers on HGTV that I think talk about selling your home or remodeling it.
Mm-hmm.
And I don't know how true these numbers are, but they were saying something to the fact, Cory, that the typical homeowner moves every 2 to 3 years now. And my real estate agent told me it's 8 years. And I guess their argument is that you don't need to move now, right? So a lot of people are staying in place and choosing to remodel things. But they were saying that if you want to remodel your garage to make it an apartment to rent out, is kind of where they were going with it. They're like, that's a couple $100,000 now to do it right, which is crazy, which is very expensive. And so I love what you said. I'm glad that you brought attention to this. I think for homeowners, current homeowners, the grass isn't always greener. So I don't want you to think that you can sell your home for $500,000 to downsize or whatever it is, $1 million. When you go to downsize, you might have to pay a premium for that new home. And if you mortgage it, you're going to have a higher rate. So I love that you said shop your homeowner's insurance, maybe do some things to keep your house maintained, but maybe you hold off on moving, maybe you hold off on remodeling to see if the market swings back a little bit in your favor. There's also the point though, Cory, that you can't wait forever, that, prices just go up over time. So it all boils down to having your financial plan, being a well thought out financial plan, and plugging those numbers in. So if you want to do a remodel or you want to move, let us know. We can crunch the numbers for you.
Let me ask you a quick question, Jake. When you bought your first house, what was the primary catalyst for that? Like, was there a specific action, like why you bought the very first house when you did?
Two reasons probably, Cory. My rent was continually going up, but I could easily afford the rent. Rachel and I were getting more serious. So I think that was a piece of it also. I didn't buy the house though for Rachel and I to necessarily live together. However, I was getting older too. So I was like, I've rented a long time. I was very fortunate. I had a lot of money saved up for a down payment on a nice house. And, rates were low. So that's kind of what I think I just got tired of paying rent. Not again. I had a great landlord. Landlords, we're still friends today. I had an amazing landlord, had an amazing condo. You've been to my condo. It was awesome. I just felt it was time in my life to stop renting and start building a little bit of equity. And again, if I was going to get serious with Rachel, that having a home would probably be the next step in our relationship. But
how old
I'm
were
not
you
opposed
then,
to renting for people though. Go ahead.
How old were you then, roughly?
I think I bought it on my birthday. I think I bought it on my 30. Nice. I think I was 34.
Okay.
I think I was 34 when I bought it. I think I bought it in 2015.
I think that sounds right.
And I turned 34 that year. So I think I was 34, which is pretty old for a lot of people to buy their first. How old were you?
I was 30.
30?
Yeah, I was 30. And the reason though, Jake, and I didn't mean to cut you off, but the reason that I asked you that question was just because I do think when I read this, I also think about first-time homeowners or people that are currently in the market. A lot of our clients' kids, maybe you and I have some friends, people that are in that. And that's really who this market's really tough for, people that don't already own a home. And I think the big point there is it's okay to exercise some patience and some discipline, that you don't have to hurry up and jump right into that. And yes, you're correct, Jake. You don't have to, there's never going to probably be a great time and you don't want to sit around for too long. But the point there is you also don't want to rush anything because there's more. It's more than just rent payment versus mortgage costs is my point.
That's why I did the little ding there, Cory. This is a quick call to action that you have to compare it. If you're a first-time home buyer, your kids or grandkids are looking at doing that, you can't just compare the mortgage to the rent. I'm glad you said that because you're right. Taxes, insurance, upkeep, yard, roof, appliances, floors, paint, furniture. I mean, it goes on and on and on, right? And all those things are a lot of fun, but I get frustrated with people saying they're paying $2,500 in rent and they can get a mortgage for $2,000.
Yeah, throwing money away. Yes.
Throwing money away. You're not throwing money away.
No.
Especially, this is very important though, especially if your rent is $2,500 and you are saving those extra dollars that you normally would be using on home maintenance in your 401k or in your Roth IRA, right? So I don't want you, renting and then blowing everything and not saving for your retirement. So you got to make sure you're saving the difference, but you're not throwing money away. You're not throwing money away by renting.
No,
not at all.
You got to have a place to live, and it's
That's
just
right.
not that simple. So good.
That's
okay,
right.
Thank you,
That's
Jake.
right. Good. Let's go on to the next one here, Cory.
What happens if you don't file your taxes by April 15th?
Right. So this is a big one, Cory. Penalties and more penalties if you don't file an extension. The lesson here is don't wait until the last minute. You're only hurting yourself, you're hurting your wealth advisor, and you're hurting your accountant or your CPA. We know, Cory, every year, April 15th is when taxes are due. You know that every year.
I do.
So it still baffles me of why some people wait that long to file, right? Why would you, now, if you want to wait that long because you owe and you want to mail in the check, I get that. However, you don't need to wait that long to get everything ready. you're just going to stress yourself out. You're going to stress it. Now, again, maybe you own a business. Maybe you have K-1s,
Sure.
1099s. Maybe the firm, whatever, got your information late. Things out of your control. Well, you know what? You can still file an extension, right? You don't have to wait, because these penalties by the IRS, Cory, they can be substantial, and they're useless. You don't need to pay them. Like, because again, if you're not ready by April 15th and you know you're not going to be ready, go ahead and file the extension, right? And then get your stuff in order. You may need to make a payment also, though. I don't want you to think that by filing an extension, you don't need to pay necessarily.
That's important.
So again, work with your accountant, work with your wealth advisor. Don't procrastinate. You know it's going to happen every year. You know it's going to happen. So let's plan ahead.
April 15th, 2025, taxes will be due.
Right.
Now's the time to plan ahead.
Right. All right, good, Cory. All right. Want a tax-efficient portfolio? Focus on these 3 areas.
Yes, this talked about pre-tax versus post-tax investment returns, which is relevant for anybody that has money invested. But the 3 key areas to focus on for tax efficiency, Jake, that at least that were discussed in this article, but I thought this was helpful. 1 is asset location. 2 is emphasizing long-term capital gains. And 3 is planning ahead for 2025 and beyond as far as the estate tax exemption goes. The message here is that incorporating tax sensitivity into portfolio management, along with proactive planning for potential tax law changes, it can strengthen the compounding of a portfolio. So let's talk about this real quick, Jake. Can you talk about asset location?
Yes. Thank you. I'm glad you brought this up, because this is actually, some of our clients don't understand this. And I'm glad you brought this topic up. It's a very important topic. Many times, Cory, especially a new client, they may have an IRA, a Roth IRA, a brokerage account or trust, and whatever. Okay.
HSA.
Now,
yeah.
What's that?
I said in an HSA, sure, right?
HSA, whatever. And their spouse may have a Roth or a brokerage or an IRA, right? So we've got anywhere from 1 to 7, 8, 10 accounts for this client, okay, that we're managing, all of it. And client expectations many times, Cory, will be that they expect each account to be invested the exact same way. And, this particularly happens when a spouse, we're like, well, Cory, how come my wife's Roth makes more than my IRA? I don't like that.
Yeah.
Right.
Yeah.
Or vice versa. Yeah. And the reason we don't invest every account the same way is because we take advantage of asset location. And asset location is, you typically want your more tax-heavy investments in a Roth IRA, because that account grows tax-free, right? And then you want your tax-free or tax-efficient or lower tax investments in a brokerage account, because you have to pay taxes on those gains the year that they're realized. And so I want clients to understand that your friends at Falcon Wealth Advisors, we take that seriously. And when we're setting up each and every account, yes, we want to make money, obviously. We want to hit your target rate of return, but we also want to make sure that we have the right assets and the right account, and that your accounts are not necessarily going to perform the same, because it's called a portfolio for a reason. A portfolio has a lot of parts to it. So we're looking at the overall portfolio, trying to hit your target rate of return. And then we've got all these individual accounts that are going to be invested differently from not only an investment standpoint, but also from a tax efficiency standpoint. Did I answer that right, Cory?
Oh, you nailed it, Jake. Well done. That's exactly right, though, because it makes a difference. And that's what this article is highlighting. You can enhance the compounding of your portfolio by not ignoring this item.
Yeah. And then the other topic you brought up, Cory, was take advantage of long-term capital gains. Why don't we just touch on that briefly?
Yes, long-term capital gains that is relevant on a position that you own in a taxable account, a brokerage account, a trust, not a retirement account. And if you've held it for 12 months or more since you bought it, when you sell it, the capital gains tax rate for long-term capital gains is tax advantaged. It typically it's less than most of the income brackets. And this is a strategy that a lot of people do want to take advantage of, because those long-term capital gains are favorable versus short-term. If you buy something, sell it less than a year later, the money that you make on that is going to be treated the same as your paycheck from your employer, the same as your IRA distribution. It's ordinary income, so it makes a difference.
Right. And then the estate tax is subject to change. The Tax Cut and Jobs Act is going to expire in 2026. So that's just, again, getting your estate plan in order, making sure you understand what those limits are. And if we need to do some things with gifting or whatever it may be, or estate planning with your attorney, having awareness of that and not just ignoring it. Because, we all know Washington loves to change the rules on us. So again, as they change the rules, we need to adjust your financial plan and your estate plan. And that's what, again, having a tax efficient financial plan is all about in there.
And we don't have to wait until December of 2025 to do that. To your point, Jake, we can plan ahead.
Right. The problem with that, the problem with doing it now, though, Cory, is that with the election, who knows? Depending on who gets elected, that also could change. So again, you don't want to overdo it, but you also don't want to ignore it. So that's a fine line there. But
yeah, that's good. I'm thinking about planning and then execution, and the execution pieces. But the planning part, you can do it now.
Yes, you're right. You're right. 100% on that. Good.
All right, Jake.
What's next?
Your financial advisor does not want you to know about these conflicts. What is this?
Yeah, how about this one, Cory? Poking a hole at our profession here. But the article argues that advisors will tell clients to take Social Security too early, keep a mortgage too long, and avoid buying annuities, believe it or not. So
what are your thoughts?
I want to give you my thoughts, and then I want to hear your thoughts. So first, you got to understand, as a client, you only want to work with an advisor who's operating as a fiduciary with all of your assets, right? Because as a fiduciary, you have a legal obligation to put the client's interest ahead of your own, okay? So I get it, though. This profession is littered with many different types of advisors who aren't all fiduciaries. Now, when they talk about taking Social Security too early, they're referencing collecting at 62 so that you don't draw down your account so the advisor gets paid more. Yeah, I get their argument there. However, if a client waits till Social Security is maxed at 70, there's also a break even that they have to succumb to. So with our clients as fiduciaries, Cory, we will show them the numbers on 62 versus 70 and anywhere in between. And we let the client make the decision because ultimately, Cory, it doesn't really matter to me. All I care about for my clients is that the financial plan works.
Yep.
That's what I care about. And that the client fully understands the decisions they're making and that we have weighed the pros and cons with them. That's our job. That's our job. It's that simple, So I'm never going to talk a client into taking Social Security early or less. And to me, it's silly. It's laughable, actually, Cory, that I would care about a client receiving $2,000 a month from Social Security versus pulling $2,000 a month.
Agreed.
From their account. If that's going to change my lifestyle or my paycheck that much, I've got bigger problems.
Yeah, you're not much of a professional. No offense.
Right. But again, it doesn't matter to me. What about when you tell a client to keep their mortgage versus paying it off?
Same deal, though, Jake, from my point of view, is that it really depends upon their plan. And I personally feel comfortable with this because I have worked with clients where we have kept a mortgage at a really low interest rate. I've also worked with clients where they've inherited a big chunk of money and we've agreed that using that to pay the house off and eliminating the mortgage is the best use for it. It's circumstantial. It's going to vary from person to person. But my assumption, Jake, is the same thing with Social Security, that this article is arguing that if I encourage a client to keep a mortgage, keep making payments, that theoretically I'm doing that so I'm making more money so a client's not pulling a big chunk of money out of their accounts. Is that the idea?
Yeah, that's what they're saying. And again, I think some advisors might say that, but to me, it's a simple interest. It's a simple math equation. If your mortgage is at 3% or 4% and your investments are making 7 or 8 or whatever, I could tell the client mathematically, this is what's happening. Now, in today's environment, it's a little bit trickier of a conversation because if your mortgage is 7.5% and your investments are making 6, I might tell the client, let's pay off your mortgage. Right? So to me, it's simple math on that. And again, an advisor that, I think it's unethical for an advisor to tell their client to take out a mortgage on their house, to give it to them to invest. I think that's shady, right? When rates are, it makes some clients may want to do it.
Leverage could make sense for some people, but yes, I hear you.
It could. You're right. It could. Exactly. Good point. It could. And if a client has an appetite for risk and leverage, it could. So again, I think, like you said, it's case by case. I'm just saying that it's math. We're doing math. We're dealing with math, humans, and an unpredictable future because nobody can predict the future. And Our jobs as fiduciaries is to go over the pros and cons with the client. And then, Cory, we're very fortunate that you and I have literally had thousands of meetings talking about this type of stuff.
Yes.
And so sharing our experience, we could say a client did this and this is how it worked out. A client did this is how it worked out. Comes down to your personal preference. I'm going to crunch the numbers and give you the pros and cons and help you make a good decision. So.
Yeah. And I trust, Jake, that if I was your prospective client or your client and I came in to meet with you and I wanted to pull some money out of my account to pay off my mortgage, that you and your financial planning team, they can run the numbers. They can help me understand what the impact of that is on my plan. And even if my mortgage rate is low, even if mathematically it could make sense for me to invest the money otherwise, I trust that if I was meeting Jake with you and your team and it was really important to me to pay that off and it worked for my financial plan, that you would not tell me I'm an idiot for doing that.
No. I'm not going to tell you an idiot. I would check in on your psychology, though. And I'm not saying I would say you're crazy. I would just say, hey, where is this? Is this an emotional decision? And are you sure you want to make an emotional decision on a long-term financial plan? That's what I'd ask the client. And if they said yes, this is what I want, right? And these are the reasons why. And most importantly, Cory, if the financial plan still worked, then I'd be okay with it.
Exactly.
The last point is they said, which I think is a little crazy, this one. They said advisors would rather have their clients keep their money invested versus buying an annuity. Because again, if they buy an annuity, they might get a commission up front, but they don't get the long-term fee. I think annuities are way shadier than keeping money invested and keeping money liquid. So I kind of dismissed that one completely. I mean, I get it. I guess if, somebody had $500,000 and you could sell them an annuity and charge them 3% commission once versus 1% a year for, 10 years, 20 years, I think financially, but again, we don't like annuities for all the other reasons because they have higher fees, internal fees, you lose liquidity, all that other stuff. So again, I like that the article brought attention to some unethical practices. And I think it's wise of a consumer to check in with their advisors. Like, why are you telling me this advice? Give me your reasoning. Yes. And the advisor should be easily able to tell you what they think. And the advisor should be able to say, okay, this is what my advice is. This is the other side of the coin. If you want to do it, this is what that would look like. And this is why I don't think you should do it. But they should go over those pros and cons.
Absolutely. Good stuff.
All right, good, Cory. We've got time for one more here before we wrap it up. So let's go. How to put your tax refund to work the smart way.
Yes.
What you got here?
So oftentimes people find refunds or they view a refund from the IRS as found money that just lands in their bank account, and realign that thinking to understand what it actually is, which is the money that's being returned to you from the government that you overpaid. And it can be used wisely. It can be used to help enhance your financial plan. So this was talking about, Jake, how a lot of people are excited to get a tax refund. And that's great. The goal for taxpayers should be to adjust their tax withholding so they're not getting big refunds every year. But if you're getting a refund, to just ask yourself a few questions. Is it something I should apply to the next year's tax return if I'm going to need to make estimated payments? Do I need to replenish my emergency funds? Do I have high interest debt to pay off? Can I contribute the money to a retirement account? Because this just highlighted the fact that a lot of people just treat it as found money, so they spend it as found money, when in reality it was their money that can be used to help their financial plan. That doesn't mean somebody shouldn't take a trip. It doesn't mean somebody shouldn't make a purchase. The point here was just recognize it's your money and it can help your financial plan, and that's how you should think about it before you choose to spend it.
Yeah, I love that point. So when you get a refund from the IRS, you're not getting money from the IRS, you're getting a return of your money. Mm-hmm. Basically, right? So you overpaid. So that's a refund, right? Just like if you return a shirt, you get a refund, right? You bought a shirt and it doesn't fit.
I just did
it. Right? But you don't go and take that money and say, oh, I just got $50. I'm going to go blow it. No, you got a refund of money that you've already spent. And so I love that idea. Yeah. And again, you've got to enjoy life. If you need to take a trip or want to do something different with it, great. But if you can use it to pay off a credit card or to, add to your retirement account, let's do that. Let's make your financial plan better from it.
Yes, absolutely. Because it's
good.
Put your money to work after the government gives it back to you.
Yes, that's right. That's right. And I love that. I think that was from a listener previously, is that we should adjust those tax withholdings so this doesn't keep happening. Now, again, some people use that IRS refund as a forced savings mechanism, which if you lack discipline, there's some other things you can do if you lack discipline. However, if it works for you and your financial plan works, maybe it's not the worst thing. But if you don't like prepaying your taxes, then you should talk to your accountant and adjust your withholdings so you don't have that issue every year.
You know, if you treat your tax refund, Jake, as a forced saving mechanism, is the assumption there that you may not exercise enough discipline saving throughout the year? However, you will exercise discipline on this one big payday that you get when you get your tax refund?
Well, no, potentially, because some people may use that tax refund, Cory, for example, to pay their property taxes every year.
Okay.
Right. Or they say, you know what, I just use that and apply that to my credit card balance.
Okay, which makes good sense.
Yeah,
I was just thinking it's like, well, if somebody is lacking a little bit of discipline to save, presumably they might lack a little discipline with how they handle the refunds, but to each their own.
Yeah. But if you know that, if you know you like the discipline, awareness, is so important, then you can say, okay, I know I'm going to get a refund every year, and every year I get that refund, I'm just going to throw it at my credit card and try to get that thing paid off.
Smart. Exactly.
Right?
Good. Okay.
So that's what I'm getting at with it. So.
All right.
Perfect. Well, thank you, Cory, as always, for joining me. And thank you to all of our audience at Upticks. This is a lot of fun to record. Thank you again, Cory, and we hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.